Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, October 21st, 2021, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures are down. Looking at the Dow Jones futures, they're down just a little over 100 points. The S&P 500 futures down 12, Nasdaq futures down 40. On a percentage basis, they're all down about the same today after the Nasdaq underperformed yesterday. We'll get into that in just a minute, but first, let's run through today's agenda for you. I'm going to start off with that daily market recap, and we'll get into talking technically. CandleGlance, talk a little bit about the CandleGlance. Get that question once in a while, how you set up the CandleGlance. We're going to take a look at that. Then intermarket relationships. Earnings spotlight, and we'll wrap up with the three you must see. But first, let me take you over to earningsbeats.com, where if you scroll down, you'll see that you can sign up for our free Earnings Beats Digest newsletter. Just requires a name, email address, hit that subscribe button. It's published 3 times a week, Mondays, Wednesdays, and Fridays, typically out by about 8:30 a.m. Eastern. So that's about an hour before the market opens. It's a very quick read, just a couple of paragraphs and a chart, normally just pointing out something that matters to us. It could be relative strength. It could be, a breakout. Could just be illustrating price support, resistance, any of those things. But I do think it will help in your trading, maybe pick up a few things from us from time to time, along with maybe a trading idea. It could be something that's tradable if you so choose. The other thing I wanted to mention is last weekend, if you haven't checked it out, last Saturday, we had ChartFest 2021. My good friends, Grayson Rose, who's the Vice President of Operations at StockCharts, and Dave Keller, who is the Chief Market Strategist at StockCharts, and also the host of the Final Bar. They both joined me on Saturday, and we all went through our kind of our routines, how we, pick our stocks, how we set up our platform at StockCharts. StockCharts is such a powerful platform if you know how to use it and access all their great features. So if you click on this link here at the earningsbeats.com page, it'll take you to a page about ChartFest. You can see the recording. If you scroll down here, right there, you've got the recording that you can go back and check out. I will tell you, it's a 4-hour session. So we're not talking about a little 15-minute presentation. I mean, this is a lot of great information. We also all shared chart lists. If you're a StockCharts member, you can download these chart lists right into your account. You have to be an extra or a pro member because I believe basic, you only get one chart list, which is your default when you sign up. But if you're extra or a pro member, you have hundreds of chart lists that you can access, that you can have in your account. So literally, you can just download each and every one of these. If you click on Dave's morning coffee routine, for instance, you will see the various chart lists that you can get. And then right down here, you can install that chart pack. So great giveaways. Check that out. But I would go back and review the recording when you get time. It's always so much fun to listen to Grayson and Dave and how they use the website because they know it so well. The way they have their charts set up, there's an organization to it that I think everybody could pick something up from. So anyway, just make sure you check that out if you haven't already. Oh, and one last thing, we all shared 5 stocks to watch. So you can click on Grayson's 5 stocks to watch, and there's one, Home Depot. But just check those out. And Dave gives you his 5. I give you my 5. All right, let's move on. Let's take a look at what happened on Wednesday. So this was Wednesday, October 20th, yesterday. And start off Dow Jones Industrial Average. Guess what? We hit an all-time high yesterday on the Dow Jones, but we didn't close at an all-time high. So we went up, we set a new high and then pulled back, closed beneath the old high. This is setting up for an area where we could get a pullback. So I'd be a little careful. Anytime I get a false breakout like that and then come back down and close just below resistance, it just makes me a little nervous in the near term. And we are showing Dow futures down a little bit, but Dow was up 152 points yesterday. S&P was up 16. Nasdaq though was down 7. So we had a little bit of bifurcated action. The best performer was actually mid caps, up 21 points, or just over 0.75%. Small caps up about 0.7%. So these were your two winners in terms of our key indices. Scrolling down to the sectors, you can see utilities actually led yesterday, up 1.6%, real estate up 1.5%, healthcare up 1.4%. Those three have one thing in common. They're part of our defensive sectors. So we didn't get that breakout yesterday on the Dow, and we're getting a little bit of leadership from defensive groups. So maybe just I'm not worried at all about the market. I believe we're going higher. But in the near term, and I'm going to talk a little bit about history and the period that we start at the close today. In just a few minutes, I'll get into that. But this is starting to maybe look like maybe we want to pull back here for just a brief period. We'll see. Energy also had a strong day, up 0.8%. And the laggard yesterday, not a huge drop, but technology was down 0.25%. And that was the primary reason why we saw the Nasdaq pull back a little bit yesterday as well. But all in all, very good action in the market overall. Just short term, I think we could have some issues. Moving on to the 10-year Treasury yield. First, we have a few economic reports out today. Later this morning, we'll get initial jobless claims. Last week, 293,000. We're expecting them to jump up just a little bit back to the 300,000 level. Then October Philadelphia Fed Manufacturing Index. September was 30.7. We've got October coming out, and the expectation there is 25.0. So a little drop expected there. September existing home sales, looking for a little bit of a rise, 6,030,000 units. August was 5,880,000 units. And then finally, September leading indicators. August rose 0.9%. September, we're expecting a rise of 0.5%. Looking at the yield, though, we do have this uptrend intact. I believe we're going to make a run for this 175 level, but anywhere from 175, I think the big range now, and I don't know that we go back down there. I don't think we will, but anything is possible, especially if we start realizing that inflation's not a problem. If inflation starts to come back down as the Fed anticipates it will, the bottom of this could come back into play. You never think we're going to go back down there, but you just don't know. And if it happens, probably would coincide with more sideways action in the market. But if the yield continues to rise, normally what we see is the yield rising as folks sell treasuries, and that money from treasuries goes in the stock market, because when yields rise, we tend to see the S&P 500 rise. But as we rise, you can see the financials outperforming. Industrials maybe not as much, but starting to outperform a little bit. These two groups tend to do pretty well when the yields are on the rise. Moving on, let's take a look at talking technically. So what I mentioned at the top of the show was the Dow set a new all-time high. We hit 35,669.69. That is the highest level ever on the Dow Jones Industrial. So we do have a new all-time high. The problem is we closed at 35,609. And if we go back to this previous high back on August 16th, the high close was 35,625. So we are at 35,669 intraday, clearing that all-time high close. But by the end of the day, we actually came back down and closed about 16 points beneath that August 16th high. So we didn't set a new closing high. And that, coming off of this move to the upside, I think we could get a shallow pullback. I'm not looking for anything big, but I wouldn't be surprised if we were to go back beneath 35,000. I mean, that could just be 2% would be 700 points. That would take us beneath. So I'm not looking for a huge pullback, but I do think we could see a little bit of weakness here on the Dow. The S&P 500. So on the S&P 500, we closed at 4536. Now looking at the close here, and this was not the August 16th high, but rather the early September high. I like to look at candle bodies. So let's just see where we closed. 4536.95 on September 2nd. and that is your high close. Yesterday, we closed at 45.36.19, which was about 3/4 of 1 point beneath that high. We've had a big run up. So this is an area where, I would expect a little bit of selling to kick in. And, like I said, futures are down this morning. Maybe this is where we go back, maybe test that rising 20-day moving average. This is a nice little cup. Maybe we get that pullback to the 20-day would be your handle. And then I think we'd potentially be ready to launch. And a breakout would be very bullish back above that 45. Let's just call it 45.40. I mean, if we get through 45.40, we'll be setting new records. All right, one other index chart. Let's take a look at the Nasdaq, because the Nasdaq is not back to that high that we saw in September. Still got a little bit of room there, not a whole lot. But if we take a look, I think it was on September 7th, we closed at right around that 15,375 level. We closed yesterday 15,121. So that's 250 points roughly, which would be about 1.7% shy. So the Nasdaq's been underperforming. It underperformed on the way down. It's actually been coming back pretty nicely, but still got just a little bit to go. But this too is at a key area, because I see maybe a neckline that we put in a little higher, an upsloping neckline, which I think is bullish. So you come down, you put in your, let me get rid of this. You come down, you put in your left shoulder. That was the A of the ABC correction. We bounce, we put in the left side of the neckline. That's your B. And then C, where you go back down below, that A low. So A, B, C, and that also sets up potentially an inverse head and shoulders. Left shoulder, neckline, head, back up to the right side of the neckline, a pullback maybe to the 20-day EMA or maybe even slightly below, could put in a right shoulder, and then a launch. So both the Nasdaq and, well, really all three, the Nasdaq, the Dow, and the S&P set up in bullish patterns in my view. All right, so the period that I alluded to earlier, that we're coming up on, and I'll pull up the S&P 500 because I study history, and I've got a spreadsheet that goes all the way back. It's got every day's close since 1950, and then I analyze the data. And the one thing I found in all of my analysis is that the October 21st close to the October 27th close historically is the worst week of the year. Now, doesn't mean it goes down every year. Don't, take this and run with it and say, oh, Tom said we're going to crash. That is not at all what I'm saying. In fact, many times October 21st, 27th goes higher. But there is the tendency, the annualized return during this period is the worst of any 6 consecutive day period in the market throughout the year. And that's on the S&P 500. I know I've done work on the Nasdaq as well. This is also a very poor week historically on the Nasdaq. So when it aligns with technicals, that's when I pay a little bit more attention to it. And so I just talked about how the S&P is hitting resistance. Now, maybe we break out. There's nothing that says you hit resistance, you can't go through. So we could possibly just take off and go right on through. But I know historically this is a weak period and I'm hitting resistance. What does that mean? Would I short the market? No, personally, I would not. We are in a secular bull market. I rarely short in a secular bull market. What I do is if I think things are just getting a little bit overcooked to the upside, is I'll start to build cash. And I have done some of that this week. As some of my positions have moved up, I've been slowly peeling some off. So I'd say across my account, I'm probably 70% invested, I would guess, 30% cash right now. Might be a little bit more cash than that, but that's not too unusual. As I get toward the end of the month, we get near options expiration or into the beginning of the following week. That's when I tend to pare down my positions anyway, simply because of options expiration and the impact that that has every calendar month, not just the October period. So I just think it's prudent to kind of take a little bit off the table as you get past the 15th of the month and you start moving, toward the 18th, 20th, because historically, not just in October, but every calendar month, the 19th to the 25th is the worst period. So knowing the 21st to the 27th is bad in October, and then knowing we're testing resistance and potentially need a pullback for the bullish patterns, that just all kind of lines up to me that we might just have a little bit of difficulty here over the next few days. But we got a lot of earnings coming out. Maybe get some big surprises. Maybe the earnings will carry the market to new highs. I wouldn't rule out any possibility. This is one thing that Dave Keller was talking about at ChartFest. You've got to be prepared for everything. You know, if all you think is the market's going to go higher and you're 100% invested, or worse yet, you're, you know, in margin, and you don't pay attention to the seasonal period, and you don't pay attention to technical developments like hitting resistance and failing, at least initially, I think that sets you up to make poor trades, because then you're in margin, the market starts to pull back, you're losing more than your account balance, or more than you know, normal investment, because you're in the margin. And then you start selling after we've seen a pullback, you know, because you're, you know, worried about losing more money, and then the market turns back to the upside. It's just a can be a really tough time emotionally, so you got to be careful there. But I believe the S&P 500 here is at least capable of a short-term 1-2% type move to the downside. I'm not looking for a 10% move this week, but could we pull back 1% or 2%? Yeah, I think we could. So we'll see what happens. All right, moving on. So CandleGlance. What I wanted to do here with CandleGlance is, if I go back to my, you know, when I always open, I always show this in CandleGlance form. And, you know, a lot of people have written into me and said, well, I don't understand how you set this up. Can you show me step by step how you set it up? Well, you use these style buttons, these chart style buttons over here to set up CandleGlance. And so what I do is I have one that's called, well, if you don't have one, it doesn't matter whether you have one or not. Let me just show you what you do here. First thing you do is you want to set the chart up the way you want to see it in the CandleGlance. Now, what I would do, I wouldn't have a whole lot of technical indicators, or it's going to be really hard to read because these are small charts. So what I would do is maybe go out like 4 or 6 months. This one's 6 months. So I'll switch it to 4. AD line and PPO is what I have on mine, but maybe you like MACD, and which I used to use MACD. PPO is better than MACD. PPO is the same thing as MACD. It's just looks at the 2 moving averages that it compares on a percentage basis instead of price basis. So it's just easier to compare PPOs. I can take one quick glance across all of these charts and tell you which one has the most momentum based on the PPO. So energy, look at the PPO on energy, which is, you know, well, it's more than 2.5, maybe it's 3.5, something like that. On a percentage basis, it's higher than any other chart. So I know the momentum is better just by quickly comparing PPOs. You can't do that with MACDs, and I'll show you why here in just a second. So let me set this up. Let's put up here. Actually, let me cancel this. So let's say I have to set it up the way I want it in CandleGlance. So instead of PPO, I'm going to use the MACD. And instead of the accumulation distribution, what do I want to put in here? I'll tell you what, let's do rate of change. And it's a daily chart. 100 days is roughly like, or excuse me, 90 days is roughly about 4 months. And I'm going to change this chart to 4 months. So let's update this. So now I've got my MACD, I've got a 4-month chart of the S&P, I've got rate of change, and I've got my volume on here. I like the volume. I like having the volume. All right, so this is the way I'm going to set up my chart. Now what I do is I hit this little plus button, and then I type in CandleGlance. Now I've already got it in here because I use the CandleGlance, so I've already got a CandleGlance set up. But what you would do is just type in CandleGlance, no spacing, just type it in just like that. And then it's asking me, you're going to hit add because you don't have one, but because I already have it set up, I'm going to hit replace. Okay, so now when I do my CandleGlance, let me go back over here and Now hit CandleGlance. Now I've got the MACD, my 4-month chart, and rate of change. Now, when I look at this chart, I want you to take a look at the XLE, which shows the MACD is a little more than 2. But look at the Dow Jones. My MACD is almost 200. So that means the Dow Jones has better momentum than energy, right? No. Remember, the MACD is just basing it on the distance between the 12 period and 26 period moving averages. Well, if you're dealing with something that's 35,000 in value, the difference between your moving averages is going to be, could be in the hundreds, maybe even in the thousands. Well, energy, if you look at the difference between its 12 period and 26 period moving average, the price of the XLE is only $58. So we're only talking about maybe a couple of bucks. That's why this is 2, and that's almost 200. So you can't compare MACDs. They're based on price. So, and the prices are all different. That's why the PPO is better. I used to use the MACD all the time. I switched to the PPO probably 5 years ago, and it's just better. It's the same thing. The lines are going to look exactly the same. It's just, it's telling you something that you can actually use to compare between different securities. So hopefully that makes sense. But that's all you do to set it up. Pretty easy. And then once you have it, now I'm going to show you what I do with it. So now I'm going to go into raised guidance. So this is one of our chart lists. And now I've got this set up in my CandleGlance. Now, this isn't the way I would look at it, because again, I like PPO instead of the MACD. I would use the AD line instead of rate of change. But, you know, this is a rate of change over the last 90 days. And so I could quickly tell which stocks using the rate of change has been performing better. Here, Netflix, 30%. We hit 30%. So Netflix, and all of these stocks, by the way, have raised guidance within the last 90 days. So looking at this list, I already know fundamentally that they've raised guidance. Every stock that I'm looking at right now has raised guidance at some point over the last 90 days. So that might mean that when it gets to support, I'm interested in it, or it might mean when it breaks out above the 50-day moving average. You know, I'm looking at Verizon here coming up against 50-day. Maybe if it breaks out, I'm not a fan of Verizon, so it's probably a bad example. But look at ANTM, Anthem. This is one I was talking about recently. I've been watching because it's been performing so strongly relative to the healthcare providers. Yesterday, they came out with their earnings. They blew them out of the water. Look at the volume pickup and a big breakout. And they also had raised guidance in the last 90 days. So that's pretty good information to know. Twitter, you know, trying to get it back through 67.50 had a false breakout, but if it had come up and gotten through there, that might have been a stock I'd be interested in. Look at Knight Swift, KNX. This is a transport gapping up. I think they reported their earnings gapped up to a new high. I think that's pretty bullish. Anyway, lots going on here, but CandleGlance, I think, is a pretty cool feature over at StockCharts. And it's a way to look this. There are 30 charts on here at a time. And I can just, you know, keep looking through, you know, just go to the next 30. There's the next batch. And whatever it is that you're looking for, you just kind of glance through and see if you can spot it. All right. Let's talk intermarket relationships for a minute. So intermarket relationships, there are a couple that I really like to look at to kind of determine the sustainability of a market. One, the major one for me is the XLY, XLP, and I generally will go out. I always use a line chart when I'm looking at price relative charts. I think candlesticks just make just too much noise on the chart. I'm going to go back. Let's just go back 10 years. I mean, this bull market's been going on for a while. And check out the XLY versus the XLP. I'm going to add one more thing on here too, and that's going to be the correlation to the S&P 500. So here's the move to the upside. Look at the positive correlation to the S&P 500. So essentially, if this line's going up, that generally means stock market's going up. So if we're moving higher, if discretionary stocks are outperforming staple stocks, that's bullish for the market. Look what we're doing right now. We're breaking to new highs. if we're going to have a bear market, or if we've got big weakness coming, somebody forgot to tell Wall Street. Really? You think Wall Street doesn't know? The XLY breaking out, this is very bullish. Another relative chart and relationship that I like to look at, actually, I like to look at transports versus utilities. Well, since April, look what's going on. We went up and set a new 10-year high back in maybe May, pulled back, and now we're starting to run again. Transports versus utilities. Utilities are defensive. Transports do well when the market or when the economy is starting to strengthen. So following this relationship pretty strong. Now, the correlation is pretty positive, but it's not as positive as the XLY XLP. I think the XLY XLP is a better indicator. And you know, over the last 10 years, that's been going up. The trend's been going up for a while. With the transports and utilities, it's a little bit more feast or famine. You know, we either go up or back down, and we haven't really done much over the 10-year period, but it's bullish for the market when we are rising. Some of the bigger moves in the market, 2012 to 2014, we had a big move in the S&P. 2016 to 2018, beginning of 18, big move in the market. What have we done in the last, since March of 2020? Big move up in the market. All of those coincided with this ratio going up. So anytime this ratio goes up, if we go up, get another breakout, that's a very bullish sign for the market. Got to be aware of these moves. All right, earnings spotlight. I tell you what, we're going to combine the earnings spotlight and the 3 you must see. But first, I'll just give you a couple of these because just need to know what they're doing after their earnings report. Tesla came out with their earnings yesterday after the close. You can see it's down $14 pre-market. Easy beat on the bottom line, $1.86 versus $1.39. IBM getting hit down more than 5% after beating earnings expectations, $2.52 versus $2.49. IBM for many years just can't get out of its own way. Don't like the stock. Lam Research, easy beat, $8.36 versus $8.13, down 3.5% though, down $20. And you can see this is one that's not been performing well. Lam Research going into its earnings, struggling a little bit. CSX, this is a railroad, up 3.5% pre-market. So we'll see what happens there. But CSX has been performing pretty well versus the railroads. And I said this could set the stage for how the railroads report. And you can see a pretty good report there. So let's go in and look at let's do the 3 you must see. These were 3 big reports that came out yesterday. I'm going to show UNP because that's another railroad. It reported today it's down 0.75%. But let's take a look at the charts here on CSX, and I'm going to go through these very, very quickly. But CSX relative to the group has been going up relative to railroads, and that's why. And it's right up here at resistance. So this 3% move to the upside is a breakout at the open on CSX. UNP is one that you can see the AD line's been going down. Relative strength pulling back a little bit off of that previous high. And it too has been trying to get through resistance, unable to based on the early market reaction today. The last one I'm going to pull up is Las Vegas Sands. Las Vegas Sands missed on their earnings expectation yesterday. Look at the stock going down. Look at it relative to the gambling stocks, and then look at gambling stocks relative to the S&P. When you get a stock that's just performing this poorly, I don't expect much out of earnings, and we didn't get it. It was a miss for Las Vegas Sands. All right, that's it for me. I appreciate you tuning in. I'll be back next week, Monday, for your next Trading Places Live over to Earnings Beats. Everybody have a great rest of your day. Be careful out there as the earnings pour in, and enjoy your weekend. See you next week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.